Assalamu alaikum students. This is Capital Budgeting video lecture series part 2. In our previous video lecture, I have shown you how to calculate payback period, how to calculate discounted payback period. We have also learned net present value and interpretation. Right. So today we will start with internal rate of return method. This is another very useful and very important method of project evaluation. Right. So here the internal rate of return method is what? So the IRR, so in short, the internal rate of return, in short we call it IRR method. So the IRR or the internal rate of return represents the discount rate at which NPV of an investment is zero. So that means that's why it is also called break-even cost of capital. That means the maximum return that we can get from a project to accept the project. So that means the IRR represents the maximum return that we can get from a project. Right. So the decision rule is what? If it is an investment type of project, that means the cash outflow precedes cash inflow. So if it is an investment type of project, that is the normal project where the cash outflow precedes cash inflow. In such case, that means where we need to invest a lump sum amount of money at the beginning of the project to get net inflows in future. So in this type of project, this type of project is called investment type of project. I will repeat again. Investment type of project is the project that require some initial investment. So that means initially you need to make a lump sum amount of investment for the project to start, and then you may get some net inflow or outflow in future. Right. So the investment type of project. So for investment type of project, projects with IRR greater than the cost of capital should be accepted. So projects with IRR greater than the cost of capital or required return or hurdle rate should be accepted. I will explain it in detail later. So now, if it is a financing type of project, that means cash inflows precede cash outflows. So that means you get cash inflow first. That means you get some cash advance from the customer to perform a particular task. So in such case, this type of project will be called financing type of project. So this type of projects generate revenue first. That means customer pay in advance. So if it is a financing type of project, in that case, accept the project when IRR is less than the discount rate or required return or hurdle rate. Right. So that means the rule will be just opposite. So how should we calculate internal rate of return? So to calculate internal rate of return, we need two NPV, one positive NPV and one negative NPV, but very close to zero. So to calculate IRR, we will need two NPV. We will need to calculate two NPV at two different discount rate, where one NPV should be positive and the other NPV should be negative, but very close to zero. Right. So the formula for IRR is this one. Alright. So let's solve one problem before we move forward. Right. So let's see question number 4 from my handout. This is from the page 42 of the handout. Question number 4. So question here it is asking that find IRR of the following project. Find IRR of the following project. So here, as you can see, we have two NPV with positive value. So here two positive NPVs are there at 18% and 20% respectively. And then we also have two negative NPV at 22% and 24% respectively. So if you notice carefully, when the discount rate was 18%, at that time NPV was 18,849. Right. But if you increase the discount rate to 20%, NPV is reduced. So that means if you increase the rate, NPV means net present value. Always remember, if you use higher rate, present value will be lower. If you use higher discount rate, obviously present value will be lower. So if you use higher discount rate, net present value should also be lower. So if you use higher discount rate, net present value should also be lower. So when it was 18%, net present value was 18,849. When we use 20% discount rate, net present value reduced to 8,144. Now when we increase the discount rate further, we can see NPV has gone down further and moved to and fall down to 1500 minus 1513. So if you can notice, so we have studied in our NPV in our last class. So here NPV is negative. That means project cannot be accepted. Project cannot be accepted. So IRR is the maximum return that we can get to accept the project. That means IRR is where NPV is 0. IRR is where NPV is 0. Let me write it. So IRR is the rate of return, is the discount rate or rate of return for which NPV is 0. So that means the maximum return that we can get from a project. So that means the maximum return. So IRR is the maximum return. So IRR is the maximum return. IRR is the maximum return that we can get, that we can achieve from a project, that we can achieve from a project. So if you notice carefully the example that we were solving, so here when the rate was 20%, at that time NPV was 8,144. So when we move to 22% discount rate, at that time NPV becomes negative. So as I said before, so to calculate IRR, we will need one positive NPV and one negative NPV, but it has to be closer to 0. So here we have two NPVs with positive value. So here we have two NPVs with positive value, but this one is closer to 0. So here we have two NPVs with positive value, but this is the NPV that is closer to 0. So we will use this one for our IRR calculation. And then again here we have two negative NPVs. So here we have two negative NPVs. So among these two negative NPVs, this one is closer to 0. Among these two negative NPVs, this one is closer to 0. So that means we will use to calculate IRR. We will use mainly these two NPVs. So to calculate IRR, we will use these two NPVs. This one is the positive one and this one is the negative one. So to calculate IRR, we will use these two NPVs. So that means NPV has to be somewhat in between 20 and 22%. So that means IRR is 0. NPV is 0 at IRR. So that means we need to find out the IRR. So IRR must be in between 20% to 22%, because when the discount rate is 20%, NPV is positive 8,144. When the discount rate is 22%, NPV is negative. So we need to find out where NPV is 0. That means we need to find IRR we need to find out the discount rate where NPV is 0. So obviously NPV is 0 somewhere in between. So NPV is 0 somewhere in between. That means NPV is 0 when the discount rate is between 20 to 22%. Right. So let us calculate these ones. So let us calculate IRR then. Right. So here, so when the discount rate was 20%, in that case NPV we found is 8,144.71879. This is the NPV we got at 20% discount rate. When the discount rate is 22%, at that time NPV becomes negative. That means minus 1513. So minus 1513.96197. So to calculate IRR, we will use this formula. So L plus NPV L divided by NPV L minus NPV H multiplied by H minus L. So here L is the lower rate between these two. These are the two discount rate we will use, because as I said before, this is the positive NPV close to 0. This is also the negative NPV close to 0. So among these two discount rate, 20% is the lowest one. So among these two discount rate, the lowest rate is 20%. So L means the lowest rate. So 0.20 plus and NPV at lower rate. So that means this is the NPV at lower rate. So this is the NPV at lower rate. So 8144.71879, and these will also be in the denominator. Right. So always remember, the positive NPV should be in the numerator, and you should also write the positive NPV in the denominator like that, and then minus NPV H. So NPV H means NPV at higher rate. So this is the higher rate among these two. This is the higher rate among these two discount rate. This is the higher rate among these two discount rate. So this is the NPV H. NPV at higher discount rate. So minus 1513.96197. Right. Now then multiplied by H minus L. So higher rate minus lower rate. So higher rate is obviously 22%. So higher rate is 22%, and the lower rate is 20%. So now if you calculate, you will see that. So in the numerator we have 8144.71879. So 8144.71879, and these minus and these minus will always become plus in the IRR formula. So actually you can just directly jump to here. So you can directly jump to here. So 1513.96197, and here 22% minus 20%, that is 2%, that is 0.02. Right. So now if you calculate it, you should get the value somewhere in between 20 and 22%. Right. So let us calculate this one. So now let me show you how to calculate this one using a scientific calculator. So as you can see here, so we have 0.20. So 0.20 is there. So 0.20 is there. We can type it like that, 0.20 plus, and then we can use a fraction. So here this is the fraction button. We can use this fraction button to calculate this one very easily. So this is the fraction button. If you press it, get the fraction button like that, you will get it like this way. So in the numerator we have 8144.71879. so in the numerator we have like this. So in the numerator I have typed 8144.71879. now if you can notice, the cursor is in the numerator. Now the cursor is in the numerator. So I need to bring the cursor here. So this is a touch screen. I can just touch it there to type it there. So 8144.71879 and then plus 1513.96197. so we can type it like this way. And then the cursor is in the numerator, so we need to come out from the denominator. So I can just touch it in there, so to bring the cursor in the normal position, right? So multiplied by 0.02. So multiplied by 0.02. So if you type it like this way, in the calculator, so if you type it like this way in the calculator and press equal, you should get the answer. So the answer is 0.216865. So 0.216865. So the answer is 0.216865. So IRR is the rate of return. IRR is the maximum rate of return that we can get from a project. So obviously rate of return should be represented in percentage. So if you convert this one to percentage, we will get 21.6865 percentage. So this is the IRR, right? Okay. Right, so now let us solve this question. Right, so what we have in this question: find IRR of the following project. So we need to find out the internal rate of return of the following project, and we need to provide decision if required return or hurdle rate or cost of capital is 25%. So sometimes it may be called as required return, or sometimes you may get it like hurdle rate or cost of capital. So it may have different name, right? So basically what we need to do, we need to find out the IRR and we need to evaluate the project where the required rate of return is 25%, right? So let's do it. First of all, so if you notice carefully, so to calculate IRR we will need one positive NPV, but here we have three positive NPVs. But this one, which one is closer to zero? Well, obviously we can see it in blank eyes. This one is the most closer to zero. So this one is the positive NPV, that is most close to zero, right? So this is our target NPV, obviously. So in that case, so right, so this is our target NPV. So among all these three positive NPVs, this is the one close to zero. So this is our target NPV, right? So again we have three negative NPVs. And among these three negative NPVs, this one is the closer to zero. This one is the closer to zero. This one is the one close to zero, right? So that means these two NPV is our target. This one is the positive NPV and this one is the negative NPV. And obviously, so we know the formula for IRR. So formula for IRR is L plus NPVL divided by NPVL minus NPVH multiplied by H minus L, right? So here among these two NPVs, this is the lower rate discount. This is the NPV we got at lower discount rate. So this is the lower discount rate. So 24% is the lower discount rate. So L means 0.24 in this case. So this is the lower rate and this is the higher rate. So NPV at this rate is this one. Obviously the positive one will always be in the numerator. So positive one will always be in the numerator in IRR calculation. So similarly again we should write this one in the denominator also. And then this is the minus from the formula. And now we need to write this one. And this is again minus. So minus a always we will get a plus. So we can directly write 1415.7951. We can directly write this one because this is the minus from the formula, and again here we have a minus. So minus a we will have minus multiplied by minus, we will have a plus there, and then higher rate minus lower rate, higher rate minus lower rate. That means the difference between these two rate. Obviously, so difference between these two rate is here 2%. So we can directly write 0.02 here. So 2% means 0.02. So now we can calculate it very easily. I have shown you how to calculate this one before. So the answer is 0.245691. So if we convert it to percentage, so the answer is 24.5691 percentage. So if you notice carefully, the rate should be in between this 24% and 26%, because when the discount rate is 24%, NPV is positive. When the discount rate is 26%, NPV is negative. We know at IRR NPV is 0. So at IRR NPV is 0. So NPV 0 should be a discount rate somewhere in between 24 and 26%. So that's what we got. So the discount rate, so at 24.5691% discount rate or hurdle rate or required return, NPV is 0. So the IRR is, so NPV is 0 at this percentage of discount rate or hurdle rate. So that means this is the IRR. Now the question is asking us to provide decision if the required return is 25%. So question is asking us also, question is also asking us to find out, to provide decision. We need to provide decision about the project where the required rate of return is 25%, right? So the project, so the comment decision will be what? The decision. So we can see the project will generate, so project will provide a maximum of so the project will provide a maximum of 24% 5691 percentage of return. So project will provide a maximum of 24.5691% return. So project will, so that means this is the maximum return we can get from the project. So that means the project will fail to provide, the project will, so the project will fail to fulfill the, will fail to fulfill the project will fail to fulfill the required return of 25%, required return of 25%. We needed 25% return from the project, but as we can see, the maximum we can get from the project is 24.5691 percentage. So the project will fail to fulfill the required return of 25%. So the project should not be accepted under. So the project should not be accepted. So the project should not be accepted under current projected scenario. So the project should not be accepted. Should not be accepted under current projected scenario. So that means you may need to forecast your future cash flows again. So if you can get higher cash flows in future from the project, in that case rate of return you may get higher from the project. In that case you may be able to accept the project. So in future you may need to try. So that means if you can reduce the cost and if you can improve the revenue from the project, in that case net inflow will be higher in future. So if you can improve the net inflow situation from the project, in that case the project may be accepted. That means project may generate 25 or higher return. That means in that case you may be able to accept the project. But under present projected scenario, we are not able to accept the project because it failed to fulfill our required rate of return of 25%. So the project should not be accepted under current projected scenario, or we may need to reevaluate our required return criteria. So we may need to reevaluate our required rate of return to accept the project. So that means if you can look for cheap source of capital, in that case your cost of capital will be lower, and in that case you may be able to ask, or you may able to look for lower required rate of return. So in such case you may be able to accept the project. So that means the project will provide a maximum of 24.5691% return. So project will at present it is failing to fulfill our required rate of return of 25%. So project should not be accepted under current projected scenario, or we may need to re-evaluate our required rate of return to accept the project, or we may even try to reduce our projected cash outflows, and we may try to improve our projected cash inflows so that the net inflow should be higher. That will give higher rate of return to accept the project, right? So in the exam you need to write the decision very nicely like that way, right? So now let us study what are the advantages and disadvantages of internal rate of return method, right? So advantage of IRR, obviously like in net present value method, IRR method also consider time value of money, because IRR method, to calculate IRR we need one positive NPV and one negative NPV. So that means IRR method also considers time value of money, right? So IRR gives a percentage and therefore it's easily understood. So that means from IRR we can get an idea that what will be the maximum amount of return that we can possibly get from a project. So IRR gives a percentage return. So that means it's very easily understood. This method uses cash flows, not profit, obviously, like net present value method. This method also uses cash flows, not profit. It considers whole life of the project. So, which means internal rate of return method considers whole life of the project, like NPV. Right, let's see what are the disadvantages of IRR. Well, it's not a measure of absolute profitability. Like, for example, if you use NPV method, we can easily find out the surplus amount of dollar or taka that we can get from a project. So that means if our cost of capital is 15% and if we get positive NPV, so that means in that case we can easily understand that how much extra we can get above the cost of capital, above the required rate of return. So NPV gives absolute profitability, but IRR does not give. IRR is not a measure of absolute profitability, right? So interpolation only provides an estimate. So the formula that we have used before to calculate IRR, this is an interpolation formula. So that means this formula, so if you calculate IRR using that formula, that is the interpolation method, in that case you can get only an estimate of IRR. But if you want to get an accurate estimate or accurate result of IRR, you will need to use a spreadsheet program like Microsoft Excel or financial calculator like that. Okay, so that means if you want to get accurate IRR, you can only get it from spreadsheet or financial calculator. Well, it is fairly complicated to calculate, because if you want to calculate IRR, you need to have some basic understanding of time value of money, or financial, you should have some financial knowledge, right? So one major disadvantage of IRR is non-conventional cash flows may give rise to multiple IRR, which means the interpolation method cannot be used. So that means if you have some non-conventional cash flows, like multiple change in sign in the cash flows, if you have multiple change in sign in the future cash flows, then you may get multiple IRR, and those IRR will be just meaningless because you cannot consider one over the other. So this is one of the major disadvantage of IRR method. So now let's see modified IRR. What is modified IRR? As I said before, so if you have multiple change in sign in the future cash flows, you may get multiple IRR. So, and those IRR, one IRR is not, that means you cannot consider one over the other. So that means multiple, when you get multiple IRR, you cannot consider one over the other. That means IRR will be just meaningless in that case. So in such case, if you have multiple change in sign in the future cash flows, then we need to use modified IRR, or in short MIRR. So suppose the cash flows from a project are these. So that means as we can see here, we have two changes in sign. So from here to here there is a one change in sign, and from here to here there is another change in sign. That means we have two changes in sign in these cash flows. So because we have two changes in sign in these cash flows, we will get two IRRs. So that means here we have two changes in sign, or we have a flip-flop. So this type of project will have multiple IRR, such as this project will have two IRR. So this project we have two changes in sign, because of that we will get two IRR. So which IRR should we consider? As you know already, IRR means the maximum possible return we can get from a project. So here we have two IRR. So it looks like that we may get 10% maximum return from the project. Again, when we look at these one, it looks like that we may get maximum 20% return from the project. So that means there is some inconsistency. Which one should we consider as the maximum return from the project? So that means we cannot consider one over the other. So in such case, IRR will be just meaningless. So in a case like this, IRR does not make any sense. So IRR cannot be used in this case. So in that case, what we need to do? We need to calculate modified IRR. In this case, we need to calculate modified IRR, right? So in theory, if a project have k changes in sign in cash flows, in that case we may have k number of IRR, right? So how we can solve this one? So the example that we have used, in this example we have two changes in sign, so we may get 2 IRR. So to solve this problem, to come out of 2 IRR, we can calculate modified IRR. So how we do this? So pay attention here. So these are the cash flows. This is the initial investment at period 0. This is the cash flow we will get after year 1, and this is the negative cash flow that we may get at after year 2. So what we can do to come out of this, to come out from this one negative cash flow, what we can do? We can bring this cash flow at period 1. So that means we can calculate the present value. We can use the present value formula to bring this cash flow at period 1. So that means we can go 1 period behind. So that means we can move this cash flow 1 period behind. So that means we will divide it by 1.14, or we may do it like this way also, minus 132 multiplied by 1 plus r power minus 1, because we are moving 1 period behind. So we can do it like that. So we already know that the present value formula is P is equal to F into 1 plus r power minus t. So here we are moving this cash flow 1 period behind, so we will use present value formula. Since we are moving 1 period behind only, power will be minus 1. So this is the cash flow, and we are moving 1 period behind, then in that case we will use the power minus 1. So we may write it like this way also. So that means if you remove the minus from the power, it will go into the denominator. So we can do it like that way also. So here, so we are assuming that if you deposit all cash flows generated from the project or from the business in the bank, you will get 14% return. And in that case, that means if you deposit your cash flows in the bank, you will get if you get 14% return. In that case, here the R we will be using is, so minus 132. So R we will be using is 14%, that means 0.14 power 1. So power 1. So power 1. So if you calculate, you will see that the answer is this one. So minus 115.789. Now, so that means this cash flow is, we already brought this cash flow. What we have done is we brought this cash flow to period 1. So now we have only these two cash flows. This is the cash inflow, and as you can see, this is a cash outflow. So this is a cash outflow. So if you deduct this one from this one, what we can see, there is a net inflow of $114.21. So that means there is a, after adjusting these one, after deducting these one from these one, we can see there is a net inflow of 114.21. Now, as we can see, this is one cash flow and this is the initial investment. So now we can easily calculate IRR. So now that means now we have what? Now we have only one change in sign. So now we have only one change in sign. At period 0, we have negative 100. That means initial investment is 100. So that means at period 0, we have this 100. And at period 1, so at period 1, we have a net inflow of $114.21. So at period 1 we have a net inflow of 114.21. So at period 1 we have a net inflow of 114.21. So now if your cost of capital, that means if you have invested money in the business by borrowing money from the bank, and if the borrowing rate is also 14%, if the borrowing rate, that means if you have borrowed money from the bank at 14% rate, in that case IRR, we can easily calculate IRR. So IRR will be equal to what? So we can calculate NPV first before we can calculate IRR. So the NPV, we can calculate NPV at 14% rate. So NPV at 14% rate will be equal to what? So we need to calculate present value of these one at period 0, right? So that means 114.21 multiplied by 1 plus R, which is 14% minus 1, and then from that we need to deduct the initial investment. So if you do this calculation, you will see that NPV will be 0.184. NPV will be 0.184. So NPV at 14% we got positive, that means 0.184. So to get a negative NPV, we can increase the cost of capital or required return from the project. So if we use 15%, in that case, let's see what we get. 1 plus 0.15 power minus 1 minus initial investment. Let's see what we get. So if you use 15%, in that case there will be a negative NPV. So minus 0.686. So minus 0.686. So we got one positive NPV and one negative NPV now. Now we can calculate IRR as usual method, because we only have one. Here we have only one change in sign. So that means we can only get one IRR now. So these will be called modified IRR. So because these will be called modified IRR because we already brought this cash flow to period 1 and make some adjustment there to get only one change in sign, so that we can get only one IRR. So because we have done some adjustment with the cash flows, so the IRR that we will get from this method will be called modified IRR. So we can easily now calculate IRR, so which will be called modified IRR, but we will use the normal formula. So formula is L is equal to L plus NPV divided by NPV minus NPV multiplied by H minus L. So here the lower rate is obviously 14%. So here at lower rate we will always get positive NPV. So here we will have there is a minus from the formula, and again here is a minus. So minus multiplied by minus, we will always have a plus here in this formula, and the difference between this lower rate and higher rate, as we can see, is 1%. So we can, that means 0.01. Now if you calculate this one, what we will get? So IRR is 14.21%. So IRR will be 14.21, that means 0.1421, which is equivalent to, which is 14.21%. So since we have done some adjustment with the cash flow to get only one IRR, we will call it modified IRR. But as I said before, using this formula, you can only, this is called interpolation formula. Using this formula, you can only get a rough estimate of IRR. To get accurate estimate, you should use Microsoft Excel, that means any kind of spreadsheet programming, or you can use financial calculator to get the accurate result. So to get accurate result of modified IRR, you can use these Excel formula. Right. Now let us move to capital rationing using profitability index. So capital rationing using profitability index. So when should we go for this one? Suppose you have multiple projects in your hand. So you want to evaluate multiple projects. So you have multiple projects in your hand, and most of these projects are good because NPV, most of the projects have NPV positive. Now, so let us solve one problem from capital rationing to understand capital rationing better. So let us solve one question from handout. So this is page number 84 from my handout. So let's see what we have in question number 6. Right. So a company is considering the following 5 investment projects and has $100,000 available for investment. So a company is evaluating 5 investment projects, and the company has only $100,000 in their hand for investment. Right. So all these projects are divisible. That means you can partially complete each of these projects, and let us assume that if you partially complete any of these project, you may get partial revenue also. That means you may get partial NPV also. If it is like that, question is asking determine which projects should be chosen first, or which projects should be chosen to maximize return to the business. So that means we have 5 projects in hand. So which projects should we need to allocate? So we have only $100,000 in our hand. So we need to find out which projects we should invest first. So that means which projects should get our capital first. So if you can see carefully, you will see that project A will need 40,000. These are all in thousands. These figures are all in thousands because there is a bracket here, there is 3 zeros are there. So that means these are all in thousands. So that means project A will need $40,000 initial investment. So project A will need $40,000 initial investment. This is 40K or $40,000. So that means project A will need $40,000 investment, and it will give us $20,000 NPV. Right. Project B will need $100,000 investment. It will give $35,000 NPV. Right. So as we can see, all these NPVs are positive. Which means all these NPVs are positive. That means all these projects fulfill required rate of return. So that means all these projects can be accepted, are good projects. All these projects have positive NPV. That means all these projects fulfill required rate of return. So that means all these projects can be accepted. But we have shortage of capital. If we have sufficient amount of capital, we can invest in all these projects. No problem with that. But since we have shortage of capital, we have only $100,000 in our hand. So we cannot invest in all the projects. If you want to invest in all these projects, positive NPV projects, that means if you want to invest in all these projects, you will need $250,000. So if you want to invest in all these 4 projects with positive NPV, you will need $250,000. But you have only $100,000 in your hand. Since you have shortage of capital, you need to develop some priority. So that means you need to rank these projects. You need to develop ranking of these projects. That means which project is best. So the best project should get investment, should get its capital first. So best project should get priority, right? So how should we identify which project is best? So for this one we can calculate profitability index. So for this one we can calculate profitability index. So profitability index means what? So profitability index means, so profitability index in short we call it PI. So PI is equal to NPV divided by initial investment. So we will calculate profitability index to find out the best project, so to develop ranking. So that means, so we will find out the ratio of this one. So that means NPV divided by initial investment to develop a ranking, right? So as you can see here, project A needs $40,000 initial investment, and it will give us $20,000 NPV, right? So that means it will give us $20,000 in NPV. It will give us, project A will give us $20,000 NPV from $40,000 initial investment. So that means profitability index is 20 divided by 40, which means 0.5. So project B will give us $35,000 NPV from $100,000 investment. So profitability index is 35 divided by 100, which is 0.35, right? So that means, so here as you can see, now we can develop ranking. So highest profitability index should get first rank. So here this one is 0.50. We can write it like 0.5 means 0.50. 0.5 means 0.50. So this one is 0.50. This one is 0.35. This one is 0.48. This one is 0.3. So this one, project A got highest profitability index. So project A got highest profitability index. So this is the best project, because the profitability PI value for this one is 0.50, whereas the other projects have lower value of profitability index. So this one got the highest profitability index. Project A got the highest profitability index value. So this is this best project out of all 4 projects. Why 4 project? Because project E got negative NPV. Project E got negative NPV, so it is out of question. It is rejected. This project is rejected because here NPV is negative. So out of these 4 projects, project A is the best project because it has the highest profitability index. So this one will be rank 1. This one will be in the rank 1. So in the second rank we can see project C is there because it has the second best profitability index. So this will be the rank, this will be in the rank 2, this will be in the rank 3, this will be in the rank 4. So these are the ranking. Obviously best project should get investment first. Best project should get capital first, right? So now we need to go for capital rationing. Right? So project A is in the first rank. So at the beginning we have $100,000 in our hand, because it said that you have only $100,000 available for investment. So at the beginning you have only $100,000 in your hand, and project A requires $40,000 initial investment. Project A requires $40,000 initial investment. So this is the best project because this is in the rank 1. So project A is the best project. So we will invest full $40,000 in project A. So after you invest $40,000 from this available fund of $100,000, you will be left with $60,000. So that means 100 minus 40, that is fund remaining after investment. After fund invested, fund remaining will be $60,000. $60,000, right? And obviously, after you do that, after you invest the fund, you will get, after you complete the project, you will get NPV amount of $20,000, right? So second best project, this is the second best project, project C. So now we need to invest in project C, right? This is in the second rank. So now when you want to consider investing in project C, when you want to consider investing in project C, let's see how much money we have in our hand. So after investing in project A, we are left with $60,000. So that means when we want to consider project C, we have only $60,000 in our hand, right? So project C requires $50,000 investment. Project C requires $50,000 investment. Do we have $50,000? Yes, available fund is 60. So we can invest 50 easily. So after you invest this $50,000, so 60 minus 50, we will be left with $10,000. And obviously project C will give us $24,000 NPV, right? Now the third rank, third best project. So the third best project is project B, right? So project B is in the third rank. Now when we want to consider investing in project B, we are left with only $10,000. We are left with only $10,000. So available fund is $10,000, but project B needs $100,000. So project B needs $100,000, right? We do not have $100,000. We have only $10,000 in our hand. So that means we cannot invest fully in the project B. We cannot invest fully in the project B, because to invest fully in the project B, we need $100,000. But we have only $10,000 in hand. Since the question told us that all the projects are divisible. So that means divisible means you can partially complete a project and you may also get partial revenue. You may complete each of these projects partially and you may also get partial revenue, that means partial NPV, right? So project B, since we do not have full 100,000, project B needs $100,000 to complete the project, but we have only $10,000 in our hand, so we can partially complete the project. So that means we can complete 10% of the project. So 10 divided by full investment is required is 100. 10 is we have only $10,000 in our hand, but to complete the full project we need $100,000. So we can invest $10,000. So 10,000 divided by 100,000. So that means we can complete 10% of the project B. So we can only complete 10% of the project B, right? So after investing these one, fund remaining is 0. So which means so this project is divisible, so it may not give you partial NPV. So but if the question says that, if the question tells you that you may get partial revenue from the partial completed project, you may get partial revenue or partial NPV from the partially completed project. In that case, we need to calculate NPV 10% of the full NPV. So that means here NPV is 35. So that means since you have completed 10% of the project, you may get 10% of this $35,000 NPV. So in that case, we will calculate 10% of $35,000 NPV. That means $3,500 NPV here. But the question says nothing like that, that we will get partial revenue or partial NPV from the partially completed project. So because it doesn't say anything like that, NPV cell for the NPV will be empty here, right? So the total NPV that we will get, so that means we will not get any NPV from the project B, since we haven't completed since we haven't completed project B fully, we have only completed 10% of project B. Since we haven't completed the completed project B fully, we will get no NPV from project B, right? So in that case, total NPV will be $44,000. So like that way, we need to allocate our capital among the best projects. Now let us look at question number 7. Here the same question with same data, only difference is here this line. In this question, the condition is saying that all these projects are indivisible. That means you cannot partially invest in any project. So you cannot partially complete any project. Either you fully, if you start a project, you must finish the project. You cannot partially invest in any project. So indivisible means if you start a project, you must finish the project. If you cannot partially invest in any project, so this is indivisible, right? So as usual, project A, same data, so that means project A is in the rank 1, project C is in the rank 2, and like that way. So we have $100,000 in our hand. So first we will invest our capital in project A because that's the best project. So initially we have only $100,000 in our hand. So project A needs $40,000. We will invest full $40,000 because we have $100,000 in our hand and we can invest in $40,000 easily. So if you invest $40,000, you will be left with 100 minus 40. That means you will be left with $60,000 in your hand. Obviously, project A will give you $20,000 NPV. So NPV is $20,000. Now next is second rank. So in the second rank we have project C. So project C requires $50,000 investment and we have $60,000 remaining in our hand after invested in project A. So after we have invested in project A, we are left with $60,000. So we have $60,000 in our hand and project C needs $50,000. So we will invest full $50,000 in project C. So we will be left with 60 minus 50, which means we will be left with $10,000 in our hand. So project C NPV that we can get from project C is 24. Right. Now the third rank. In the third rank we have project B. In the third rank we have project B. Well, project B, we can see project B requires full $100,000. Project B requires full $100,000, but we have only $10,000 in our hand. So we have only $10,000 in our hand. We do not have $100,000. So as you see, as you know that it says that all the projects are indivisible. So that means we cannot partially complete any project. So that means we cannot invest in project B. Alright. Now let's see if we can invest in the project D. Well, project D needs $60,000. That means we cannot invest in project D. That means we cannot invest in project D also because we have only $10,000. Project D requires $60,000. So we cannot invest in project D also. So that means we need to invest only in project A and C to get $44,000 NPV. Right. Now let's see the next question. So same data, same question, only the condition is different here. Here it says that all these projects are divisible and project A and C are mutually exclusive. So if project A and C are mutually exclusive, that means if you invest in project A, you cannot invest in project C or vice versa. So same data, same ranking. Now let's see if we develop a project mix to find out the best possible allocation of capital. Well, you cannot invest in project A and C simultaneously because they are mutually exclusive projects, so you cannot invest that. So out of question. Now let's see if we can invest in project A and B also. Well, you cannot invest in A and B together because you will need $140,000 in that case, because project A requires 40,000, project B requires 100,000, so not possible. Let's see if we can invest in project A and D. Well, project A requires $40,000, project D requires $60,000. Yes, we can invest. So if we invest in project A and D, in PV we will get is 20,000 plus 18,000. So 20,000 plus 18,000, that means we will get total $38,000 NPV. So if you invest in A and D, if you invest in only A, you will get only $20,000 NPV. If you invest in only B, if you invest in only project B, you will get $35,000 NPV. Can you invest in project B and C? No, not possible. You will need $150,000 in that case. You don't have only $100,000. Can you invest in project B and D? Not possible because you will need $160,000 in that case. Can you invest in only project C? Yes, we can. In that case, NPV we will get is only $24,000. So if you compare all possible project mix, we will see that project A and D will be the best possible allocation. We'll have the best possible allocation. So if you invest in project A and D, you will be able to invest all your capital and you will get highest NPV. So this will be the best allocation of your capital. Right. Now, what are the cash flows should we consider in project evaluation, and what is the difference between accounting profit and cash flows? Well, in capital investment appraisal, it is more appropriate to evaluate future cash flows than accounting profit because profit cannot be spent. For example, you have sold $100,000 amount of goods. You have sold $100,000 amount of goods, but out of that $100,000 amount of goods, your profit margin is 10%. So that means you have already calculated that you have made a $10,000 profit. So I will repeat again. So for example, you have sold $100,000 amount of goods. So your profit margin is 10%. So that means you have already recorded that you made a profit of $10,000. But that $100,000 amount of goods that you have sold, all these goods are sold on credit. So that means you haven't got the cash yet. So you haven't received the cash flow. Although you have sold the product, although you have made the sale of $100,000, but you haven't received any cash. So that means profit is not realized yet. You have no cash in your hand. So that means you cannot spend the profit to pay your worker's salary or to pay your other utility expenses, or you cannot use it as working capital also. So that means profit cannot be spent. So profits are very subjective. Well, what method you use to calculate profit, so that based on that profit can be easily manipulated. Some companies they use straight line depreciation method. Some companies they use reducing balance depreciation method. So based on that means what policy you use for your depreciation and other expenses, based on that profits can be exaggerated or profits can be undermined as well. So that means profits are very subjective. But cash is required to pay dividend. So that means cash is more important. Cash is more important. Cash is the liquidity. Cash will give you liquidity. That means cash is the bloodline. Cash is the cash flow is the bloodline of your business. So that means cash is more important. So in capital budgeting, we will mainly focus on using cash flows than profit. Right. So what are the cash flows that we should consider in capital budgeting decision? Which cash flows are relevant and which cash flows are not relevant? Right. So capital budgeting decisions must be based on cash flows. We already know that. The only cash flows that should be taken into consideration in capital investment appraisal are, well, cash flows that will happen in the future if you adopt the project. That means if you accept the project or if you start the project, the cash flows that will happen in future, only those cash flows should be taken under consideration, under project evaluation. That means if you accept the project or if you invest in the project, the cash flows that you will get in future, those cash flows should be considered only in project evaluation. So cash flows that will arise only if the capital project goes ahead. Same thing, cash flows are direct revenues from the project. So that means if you get any direct revenue because of the project, those revenues or cash flows should be considered. And relevant costs are future costs that will be incurred or saved as a direct consequence of undertaking the project or undertaking the investment. That means if you start a project, if you invest a project, all the cash outflows because of the project and all the cash inflows because of the project should be considered in project evaluation. The relevant cash flow for a project is the additional free cash flow that the company can expect if it implements the project. So that means we should consider free cash flow in project evaluation only when the project goes ahead. Right. So what should be the free cash flow? So FCFF, so free cash flow for the firm, which means the formula is we need to get earnings before interest and tax, or some people will call it PBIT, that means profit before interest and tax, and we need to do some tax adjustment there. That means that we will we need to multiply it by 1 minus corporate tax. We need to multiply it by 1 minus corporate and tax. So that means after paying tax, the amount of earnings you will be left in your hand, that should be considered here. And then along with this one, we need to add depreciation expense. Why? Because depreciation, although depreciation is deducted to calculate profit in the income statement, but depreciation is a non-cash expense. Depreciation is a non-cash expense. That means depreciation is not a real expense. That means you haven't spent any money for the depreciation. So that means cash not gone out. So that means cash is still in the company. So that means depreciation is not a real expense or real cash expense. So cash is depreciation amount of expense, the cash. So that means cash is still with the company. So that's why we need to add it back to find out the free cash flow. And then we need to deduct net increase in capital expenditures. So net increase in capital expenditure. That means if you, for example, you have purchased $1,000 amount of goods. So $1,000 amounts of inventory or raw material. So you have purchased $1,000 amount of raw materials for your business, and you have also sold some administrative goods or administrative supplies amount of $200. So that means you have received an inflow of $200 from selling some of your capital from realizing some of your capital, and you have purchased $1,000 amount of inventory. So that means net outflow is $800. So net outflow is $800. So that means $800 has gone out from your business. So we need to deduct that one. Similarly, if there is any net increase in working capital, we need to adjust that one also to find out the free cash flow available for the company, for the firm. So that means in project evaluation, we should use free cash flow for the firm only for project evaluation. Right. So in project evaluation, we should ignore following cost. Which cost? Sunk cost. Well, what is sunk cost? That means in project evaluation, we cannot consider sunk cost. That means costs that have already been incurred. So for example, you have purchased a schedule, or you have purchased a tender schedule. That means you want to participate in a bid to get a construction project. For example, there is a government requested application from prospective engineers to develop a bridge for public. So now you have submitted a project proposal. That means you want to participate in the bid for the bridge project, right? So for that one, you have to purchase a schedule. That means you have to make some expenditure to prepare the project proposal. So for example, you have made an expenditure of, you have spent already $100,000 to prepare the project proposal to apply for the bridge project, or apply for a construction project. So you want to participate in a bid for a construction project, and to prepare the project proposal, you have spent already, for example, $10,000. So if you do not get the project, this $10,000 will be sunk cost. This $10,000 cannot be materialized, cannot be realized. So that means this $10,000 that you have already spent it to prepare the project proposal for the construction project, or to bid for the construction project, that is the sunk cost, should not be, and this sunk cost should not be considered in the project evaluation. So costs that have already been incurred are not relevant in investment appraisal decision. So a company, for example, a company makes a non-refundable deposit as a down payment for an equipment, and then reconsiders when it wants the equipment after all. Right. The money that has already been spent cannot be recovered because it was non-refundable deposit. So is not relevant in the current decision about obtaining the equipment. Committed costs. Costs that will be incurred anyway, whether or not a capital project goes ahead. So that means committed costs are like costs that will be incurred anyway, whether or not a capital project goes ahead. So this committed cost cannot be relevant to a decision about investing in the project. So fixed cost expenditures, an example of committed cost. For example, if you purchase a machine, it doesn't matter. So for example, if a machine can produce 10,000 units of product every day, a machine can produce 10,000 units of product every day. Now at present you are producing only 5,000 units per day, but it can produce 10,000 units. So that means it doesn't matter. So how many units you produce, still depreciation cost will be the same. per day depreciation cost will be the same. So that means if you can run if you can run on full capacity, then you can use the machine effectively. So that means this fixed cost, that means per day expenditure of the machine, is the committed cost. That means if you can produce more, fixed cost per unit will be reduced to some extent, right? So fixed cost expenditures are an example of committed costs. So for the purpose of investment appraisal, a project should not be charged with an amount of share of fixed costs that will be incurred anyway. So that means if you it doesn't matter whether you start a project or not, some cost will be incurred anyway. So those the cost that will be incurred anyway will be considered as committed cost or fixed cost, and this should not be considered in project evaluation. So non-cash expense, as I said before, depreciation can never be relevant in investment appraisal, because depreciation is a non-cash expense and should not be considered in project evaluation, right? So that will be the end of capital budgeting chapter. So in this chapter I tried to focus only on some basic investment appraisal technique, because this is a very preliminary course of finance. So in this course we will confine our discussion to only some basic investment appraisal technique. So this is the second part of the capital budgeting chapter. So this is the second part of the video lecture series on capital budgeting chapter. So if you have any question on any part of this chapter, please do not hesitate to ask me.